Today we're talking about Cathie Wood. She just appeared on CNBC yesterday with her freshly released Big ID's 2026 report. You might remember how she fell from grace back in 2022. She used to be crowned the goddess of stocks, the tech stock goddess. But in 2022, her fund dropped 70%. Fast forward to 2025, and Cathie Wood has stormed back with her ARK fund, posting some seriously impressive performance. In this recent interview, she said some jaw-dropping things. So the question is this a comeback and recrowning of the goddess of stocks, or just the last wild gasp of a bear market rebound? We're diving deep, combining her latest holdings with data from third-party institutions to give you a full analysis.
Thank you, Scott. Great to see you. Thank you so much.
So I've read through your outlook in which you lay out some specific themes that you like, but let me just ask you, you call the U.S. economy a coiled spring for many reasons. I'm wondering how you think that translates into what the markets may do this year.
Yes, well, we think that we've been through a rolling recession. We've seen it in housing, manufacturing, small business, consumer sentiment, and that thanks to tax cuts, big refunds this first quarter, but corporate tax cuts as well, so big investment cycle ahead, as well as deregulation, which I think is highly underestimated in terms of its impact. And lower interest rates and lower inflation, sounds like Goldilocks, that is all going to play out this year and be very good for the financial markets.
You know, I thought it was interesting in reading your outlook when you talk about multiples, which are at great debate, I think, right now, whether 22 times is too rich for stocks, whether you will get multiple compression, but earnings are going to be strong enough that it's not going to matter, if you want to use that word, to the market. You, in fact, do think that multiples will compress because of productivity gains, but that stocks are still going to return double digits this year, and that some of the best bull markets have happened in times of multiple compression. Is that correct?
That is correct. We saw it in the 90s. Big multiple compression, and the market did extremely well. We saw it in the early 2000s, and even ARK in 2017 and 18. Our multiples compressed significantly, and we outperformed the markets significantly in 2017, a big up market. But even in 2018, that was a down market, and we were up, which many people didn't expect.
It's curious to me, I think, that of your 5 themes for 2026, AI is at the top of the list. But you do not own any large positions in any of the hyperscalers. You have 1% positions in Meta and Nvidia and Amazon. And we can get into Nvidia specifically in a moment because there are things I want to ask you about that. But why is that? If AI is such a big theme of yours, why don't you have bigger stakes in any of the so-called hyperscalers?
Right. So one of the reasons is we think the shareholder base of those companies is changing and will continue to change because shareholders in the last cycle who got used to huge cash flow and cash positions building, very little M&A because the FTC had shut down M&A. All of that is changing with AI now and with a new FTC. So we're seeing huge capital spending and returns on invested capital probably coming down for a while. And the shareholder base in those companies has really stayed with them because returns on invested capital had been moving up. I think this is a bit of a shock to their system. And as you know, we are very focused on, more pure play future winners. I'm not saying the Mag 6 won't win. In many ways, they will. But they certainly, any company that is in the broad-based benchmarks and has risen to the top has gotten there because of past performance and a certain DNA that worked during the last 20 years or so. We think there's so much disruption happening now, technologically enabled disruption, some that will benefit, some that will not benefit the Mag 6. So we're much more focused on, the companies that are not as well known, but are going to benefit enormously from the year ahead and the years ahead. And I will say, last year, the market starting to broaden out away from the Mag 6. We outperformed. We're in the top 5%, I think, four of the top 5 ETFs by Morningstar. And even for the last 3 years, we're in the top 5%. So I think the market is beginning to understand what we've been trying to say for.
She described the U.S. economy as a compressed spring, ready to explode upward at any moment. So what's her reasoning? First, she says the rolling recession is already over. Over the past few years, the U.S. economy went through a rolling downturn. Real estate, manufacturing, small businesses, and consumer confidence all took turns getting hit. According to her, the worst is already behind us. She also strongly emphasized Trump's tax cut policies, including both corporate tax cuts and personal tax relief, arguing that they will boost consumption and investment. In her view, the market is severely underestimating the massive impact of deregulation. She predicts that both interest rates and inflation will fall. Put all of this together, and Cathie Wood believes 2026 will be a perfect Goldilocks economy, extremely favorable for financial markets. She even laid out specific forecasts. She expects U.S. nominal GDP growth to reach 6% to 8% in the coming years, the highest in the world. For comparison, even China has been growing at only around 5% in recent years. In her model, productivity growth contributes 5% to 7%. Labor force growth adds about 1%, while inflation sits between -2% and 1%. That's an extraordinary set of predictions. What she's saying sounds less like a neutral economic forecast and more like a full endorsement of Trump-style economics. She's painting an almost perfect economic picture: high growth, high productivity, and low inflation, all driven by the belief that tax cuts and deregulation will massively unleash economic vitality. Wall Street largely buys into this logic, but many economists remain skeptical. They question whether such high productivity growth can really be sustained, and whether the low inflation outlook is overly optimistic. She doesn't say it outright, but the implication is clear. As long as Trump's policies continue, the economy's internal momentum will be strong enough that Federal Reserve interest rate policy becomes a secondary factor.
Next, the host asked the question everyone cares about. Are U.S. stock valuations, especially the S&P 500 at around 22 times earnings, simply too expensive right now? Cathie Wood's answer was interesting. She openly admitted that valuations will compress. In other words, she agrees that 22 times earnings is expensive. But in her view, that's not a real problem, because corporate earnings growth will be so strong that it will more than offset the pressure from lower valuations. She still expects the stock market to deliver double-digit gains this year. To back up her argument, she gave 3 examples. First, during the 1990s internet bubble, valuation multiples compressed, yet the market still performed extremely well. Second, in the early 2000s, valuations also compressed, and the market again delivered strong performance. Then she pointed to ARK itself. In both the 2017 bull market and the 2018 bear market, the valuations, meaning P/E ratios, of ARK's holdings were compressing. But performance still dramatically outperformed the market, because the companies they held were generating massive earnings growth. She even noted that in 2018, when the broader market fell, ARK still posted gains. That, she argued, shows that overall valuation levels may not matter that much. Though to be fair, it also sounded a bit like self-promotion. In my view, this argument sits at the core of Cathie Wood's most disruptive investment philosophy. As long as the companies you invest in are growing fast enough, you can still make money even while valuations are falling. But the real question is, does history really repeat itself that cleanly? We can't just look at 2017 and 2018 and forget what happened in 2022. That year, ARK's flagship fund collapsed by 67%, precisely because its portfolio of high-growth, high-valuation stocks was hit by devastating valuation compression during a rate hiking cycle. Let's look at the data. According to ARK's own website, ARK's total return over the past 5 years is -9%. That means if you invested 5 years ago, you'd still be underwater today. What this shows is that her framework comes with extreme volatility and places very strict demands on timing.
The most compelling part of the interview came when the host asked a question everyone was thinking about. If AI is ranked #1 among your 5 big ideas in Big Ideas 2026, then why does your fund barely hold Nvidia, Meta, or Amazon?
the AI giants. Cathie Wood's answer perfectly captured her investment philosophy. First, she argued that these giants are winners of the past. They've reached today's valuations because of their historical success, the DNA they built over the past 20 years. But now, she says, the rules of the game have changed. Second, their capital expenditures are exploding, while returns are declining. To build out AI, these mega-cap companies are pouring money into CapEx at an aggressive pace, which will likely drag down their return on investment in the coming years. For shareholders who are used to consistently high returns, that's bad news. Third, and this is basically ARK's DNA, they only invest in pure future winners. She said ARK's mission is to find companies that are less famous, but stand to gain the most from disruptive innovation. True, pure-play companies. Those comments show Cathie Wood's ideological purity, but they also reveal why ARK is a double-edged sword. So let's look at what she actually owns. According to ARK's official website, as of January 22, 2026, ARK's top holdings look like this. Number 1 is Tesla, spanning electric vehicles and AI. Second is CRISPR-related gene editing. Third is Roku, the streaming platform. Fourth is Coinbase, a cryptocurrency exchange. Fifth is Tempest AI, an AI-driven healthcare company. Then come Shopify, Robinhood, AMD in semiconductors, and Palantir in big data and AI. This portfolio perfectly validates her words. Aside from Tesla and AMD, there are almost no traditional big tech stocks. Instead, the portfolio is filled with gene editing, AI healthcare, and crypto. High-risk, high-potential companies whose business models are not yet fully mature, but which she believes are the true winners of the future. She doesn't buy Nvidia because she believes the value of AI will eventually shift from infrastructure to the application layer. In fact, she's even more extreme than Stanley Druckenmiller, who often says that by years 3 or 4 of the AI cycle, we should see an explosion at the application layer. But Druckenmiller still holds a lot of infrastructure stocks. ARK, by contrast, is fully aligned between words and actions. She says it and she does it. She's betting that companies like Tempest AI and gene editing firms will one day be more valuable than Nvidia. It's an extremely high-risk strategy, one that either delivers outsized gains or ends in total collapse.
Finally, Cathie Wood made her most controversial claim. She said, "We're in the top 5%. I think 4 out of our 5 ETFs rank in the top 5 on Morningstar." That statement carries a huge amount of information, and it's also very easy to misinterpret. So I went and checked Morningstar's latest reports myself. Truth number 1. In 2025, she really was the undisputed champion. According to Morningstar's report released on January 6, 2026, ranking the best-performing U.S. equity ETFs of 2025, ARK took 4 of the top 5 spots. Number 1 was ARKQ, the Robotics and Automation ETF, with a 48.7% annual return. Number 2 was ARKX, the Space Exploration ETF, returning 48.28%. Number 3 was ARKW, the Next Generation Internet ETF, up 38.69%. And number 5 was ARKK, the original and most famous Innovation ETF, with a 35.58% return. By comparison, the S&P 500 returned just 16.39% in 2025. From this angle, Cathie Wood calling herself top 5% is not an exaggeration at all. She was, without question, the champion of the year. Now, stretch the data out to 3 years, and ARK still looks elite. Morningstar's report shows that based on 3-year annualized returns, within the mid-cap growth category, ARKQ and ARKW rank in the top 1%, ARKK ranks in the top 2%, and ARKX ranks in the top 4%. Over 3 years, ARK's funds still outperformed more than 95% of their peers. So when she says she's been in the top 5% over the past 3 years, that statement does hold up. But notice something important. She specifically says 3 years. If you extend the window to 5 years, ARK's returns turn negative, down 9%. And this is the very heart of the Cathie Wood controversy. She is a classic cycle-driven investor. Her performance is tightly bound to market-style cycles. When the market chases growth and narratives, she looks like a genius. When the market shifts back to discipline and cash flow, she becomes a disaster.
So let's return to the original question. Is Cathie Wood's comeback a recoronation or the final frenzy of a cycle? After analyzing this interview, my takeaway is this. What we're seeing is a carefully constructed defense of a high-risk strategy built on extreme optimism and very selectively chosen data. In Cathie Wood's world, there is no middle ground, only heaven or hell. And right now, she's standing at the gates of heaven, waving everyone in.
Thank you for watching today Money Daily. If this video helpful, even just a little bit, please like, share, and subscribe. On the road to the future, we are strong when we're together. See you in the next episode.